Hey, good evening, everyone. Marty Mazzora here. It's June 25th, 2021 with your weekly macro update. Going to get right at it this evening. In front of you is our macro index. We had a nice little bump up, about 4 points this week. Call it, general conditions, economic data, 48 data points. Although from a technical analysis perspective, we've got a lower high and a lower low. That's kind of bearish, although also looks like a flag pattern. Are we going to break through that and move up to this price target here, the length of the flagpole? No, I don't think we're going to see economic conditions that score up here in the 80s like it did in early 2018. But I also don't see a lot of recession risk or much to worry about there. Hard to say that, though, without putting it into context, and that would be the context of 10 trillion of global money printing, going into bank reserves via quantitative easing. But we're also looking at big fiscal spending going forward that'll actually put some of that money printing into money supply. And that virtually by definition is inflationary. And along with the rest of our inflation thesis says that we do have real risk of longer term structural inflation. Despite what you're hearing from the Fed, despite what you're hearing from much of Wall Street, understand that it is in Wall Street's best interest if indeed people believe that this inflation is transitory, not something longer lasting. That, in theory anyway, is much better for stocks. And from the Fed's perspective, they need to let this economy run hot. We're looking at about 130% debt to GDP at the federal level, 11 trillion in corporate debt, which is utterly phenomenal. A lot of that is very low quality. So at least from a federal debt perspective, we need some inflation. We need to run inflation hot, like 5% or higher hot, to work through and to deflate this debt over the next few years. Now, inflation at that level is not good, particularly for folks on the socioeconomic ladder that we're supposed to be helping right now, or at least the powers that be say they're supposed to be helping. So better to provide a narrative that says, don't worry about it. This inflation is temporary. It's because of bottlenecks, due to COVID and so forth. So we're not going to get aggressive and raise interest rates right here. So we'll see, folks. The world is dynamic, therefore so is our analysis. Remain open-minded, crunch the data day in, day out, week in, week out, and protect against the obvious risks and take advantage of the obvious opportunities. That's what we're here to continue to do or to attempt to do going forward. So let me jump into a few of the select data points that are in our index that I want to share with you. Once again, we'll look at the dollar, we'll look at commodities. Going to finish with market breadth and show you, just yet another red flag that, says we should be hedging risk in the equity markets still. Starting with durable goods orders, they came out this last week. The up 40 is the year-over-year increase. It was up 60 last month. Of course, this is called, base effects, meaning this is where we were, a year ago. So yes, we're going to see huge moves. We told you coming out of this that the data is going to get really weird. So we got to look at things like 2-year moves and month-to-month moves. So month over month, we actually moved back into the positive. We're up 2.3%. X very volatile transportation, an increase of 0.30% over the previous month. So the durable goods signal is that the economy is growing and people are still spending money on things, like say toasters and above, things that are durable, things that last a while. Truck tonnage, we actually have yet another lower high there, and they rolled over a little bit once again. So truck tonnage, interestingly, with all the activity and so forth and the opening up, but less online sales too. So, nothing terribly negative other than the trend, right? So we'll see how this plays out going forward. The Chicago Fed National Activity Index just blipped back into the positive 0.29. 85 data points. It's an index like ours in and of itself. 55 of those 85 were positive this last month. Inflation via the personal consumption expenditures deflator, that's the Fed's supposed chosen measure, up, call it 3.4%. year over year, and again, base effects, remember what we came off of a year ago. So we're really paying attention to the monthly numbers. Came down a bit, but still up, call it 0.5% from last month. Folks, on an annualized basis, that's 6% inflation. In fact, when you add the last few months together, you have more than what we've seen annually, for a long, long time. So, wow, this is precisely playing to the script that we set forth as we began coming out of this. That is a spike in inflation, then coming down. But our broader thesis says look for longer term rising structural inflation for a variety of reasons that I continue to outline, sometimes on the video, but quite a bit on the written blog as well. The Bloomberg Commodity Index, remember, we just kept going up with these bull flag patterns, right? We would have a big steep move, consolidate, big steep move, consolidate, smaller but steeper move, broke out, and then came down right on that support level right there. And you can see that that's been a long-term resistance for this index, right, back in here. And, typically what was once resistance when you get a breakout becomes support, and it played out beautifully right there. This red line, though, takes us to something I've been showing you on the written blog. And I think I'll just take us back enough years for that line to make some sense here. So if we take our index all the way back to 1970, my illustration here is to show you that commodities tend to run in big, long trends, particularly on the bull side. So while we have real correlation, I'll probably show you more of that here in a minute, between the dollar, or negative correlation between the dollar and commodities, as well as stocks, particularly right now. When you look at the trend in commodities for the last few years, since the last recession, that is quite the bear market. And here we are now just breaking out of a very long-term downtrend. And if you look back historically, when we've broken out of these things, bull markets and commodities do tend to run for several years. The setup for that, particularly when we couple it with our longer-term inflation thesis, has us in commodities now to a greater degree, frankly, than we've ever been. The last time we had gold as a base position was right back here in 1999, and it worked out well, but we didn't keep it for very long. And right in here, when everybody was screaming, commodities, all the money printing, own gold, we didn't. Our thesis was, no, the setup structurally wasn't there just yet. We do think the setup is there now. And it looks like it's playing out that way. But make no mistake, there's going to be some consolidation. These kinds of moves are unsustainable. They need to be worked off at lower levels. And that's really vivid on the copper chart, which, as you'll recall, weeks ago when we were up in here, I was drawing arrows on this chart, down this far, and basically said, we're very bullish on copper longer term, but in the meantime, will or can we see these kinds of drops in this metal? And I said, oh, absolutely. In fact, we should expect it. And that's exactly what we're getting. Notice we came down here to about 9,000 a ton, and then bounced off of that pretty strong this last week. China has efforted mightily to get the cost of metals down. They've threatened speculators in the futures markets there in China. They're releasing strategic reserves. You can unleash those on the market if you want to bring the price down. So, that freaked people out. I think that has a lot to do with this decline in copper prices right here. So while it's bearish for the price for a country as big as China to get in there and try to manipulate it lower, the global dynamics and the big push for renewable energies just does not allow them to succeed, I suspect, going forward. Okay, so our working chart of the dollar. I think I say this to you every week. The dollar is, in currencies in general, are great to trade using these indicators. And that is where you draw your patterns, and then you use your momentum indicators, the MACD and the RSI. And then in this case, we had a rising wedge, bearish divergences. We were bearish right here, rightfully so. We were bullish right here. Now, here I was changing my tune. I said, right here, this says, technically, be bullish. If you're a trader, be long the dollar, buy it, right? Right in here, I said, we're going to probably hit that 50-day moving average and have resistance. Literally, it started playing out the next day. Then 3 or 4 days in a row, but I did say, remember, if we break out above there, right, I expect to test this line. We had this line drawn, and I said I would short it if I were a trader, short-term trader. I would short the dollar right when it hits that line. And right now, I would have made a little money, but I said if we blow through that, that's going to be very problematic for asset prices, right? And it was already right up to here. So folks, for the Fed and the powers that be to succeed in their objective going forward, which is to keep these asset markets afloat, they really can't have the dollar go higher. They can't have interest rates go higher, right? They've got to keep the credit markets and they have to keep the equity markets afloat. And they're going to have to do that by letting the dollar go, or at a minimum, keeping it at bay. Just to expand on that a little bit more and to repeat from the blog this week, the white line is the dollar, and this is just for the last month. The yellow line is the Bloomberg Commodity Index. The red line is the S&P 500. And this is week before last when the Dow gave up like 1,000 points or whatever. And just of course it corresponded right with a big jump in the dollar. And that was when the Fed sounded a little bit hawkish, right? And then you can see commodities came down hard. Stocks came down hard. And the minute the dollar began to roll over, what happened? Commodities bottomed, stocks bottomed. So we had a pretty good week, came back a bit from that rough week that we had the week before. So we have choices to make here, right? We have commodities that have been in a long bear market and they're just now breaking out. We've had stocks that have been in the longest bull market in history. And you could argue that ended right here. That was a 3-week ordeal, and within weeks, we were out of that. So pragmatically speaking, I think that was just a blip in an ongoing bull market. And certainly if that's a bear market, nothing happened in terms of deleveraging corporate balance sheets and the kind of pain that real bear markets bring. In fact, when we came out of this, we had $1 trillion more debt on corporate balance sheets than we did before. This was so anomalous, this recession was relative to history, that it's hard to even count. We're really not much has changed other than stocks are a lot higher and valuations are a lot scarier at these levels. And I must say, though, the powers that be have new tools like buying junk debt and maybe even buying stocks. So we do have to adjust our models and the way we look at the world to compensate for how policymakers seem to have a real floor under the market. We'll see how long that lasts. We'll see if it's different this time and it can actually succeed in keeping bubbles afloat and work off these excesses over the next few years without some big collapse. But we do have to do things and hedge against those prospects and be in things that look like they have the potential to do very, very well on a long-term basis, and that would be the commodities space as we sit here today. And then to the stock market. This is our ongoing chart that we've been updating for years, one of our charts on the S&P 500. We broke out of this upward sloping wedge, but we didn't really fall apart, and the 50-day moving average has been working like a charm. We've gone from a bearish signal to almost a bullish sign. This white line moves above that on the MACD. Suddenly, we have a bullish signal. And this is fine. It's not necessarily a bullish divergence, but it's not necessarily bearish either. We do have these longer term divergences, which are troubling and make this market look really heavy. We don't have a sell signal here, but this looks like downside risk. And so we'll see how that plays out. In terms of volume, remember right before we had that rough week before last, I showed you that volume, literally right before that on our volume indicator, had been really showing signs of trouble, meaning the market was rising close to new all-time highs with very, very low conviction from the volume indicator. And then when it tanked a bit, volume spiked up, which means, yeah, of course, people rushed in and sold. Now we're coming right back down and we're approaching that line again. So we just keep going through these gyrations where not a lot changes in terms of the backdrop, fundamentally or technically. And we just look like we're still sitting on a very risky market. More evidence of that comes from the breadth. Okay, so I'm going to get a little deeper in the weeds and I'll let you go here in a minute. But so this is the S&P 500, very simple line chart here. This is the number of members of the S&P 500 that are trading above their 50-day moving average, and it's below 50 right here. According to Bespoke Investment Group, who we pay attention to their research, they do a lot of good work. This is a huge rarity, and I'll show you from their latest commentary what that means. But this is a chart that we pull up and look at periodically. It doesn't rest in any of our models, but we do look at breadth from a number of angles. And this one you can see, we just had kind of classic bearish divergence here as the market was going up to new all-time highs. You had breadth breaking down relative to this one indicator, and sure enough, look what happened here. We had the nearly 20% decline in 2018. What did we have? Ugly breadth right here, right? This did not give us a signal for that 11% drop in there, but the 16% decline during these two dips right here, really big warning right here from this particular breadth indicator. Warning right here in 2014 is we had a 10% correction up in here as well. So, are these things to lose sleep over? No. But what about this one? All-time highs in the market, less than 50% of its members are above their 50-day moving average. That is quite the anomaly. Just how rare is it for breadth to be this weak when the S&P is at its all-time highs? When were those periods? That's kind of what I want to get to. They were right here in 1998 and in 1999. Okay, and behind that yellow one is the green one, which is the negative advanced decline line, and the same thing there. What happened here? Well, 1998, I remember that. That was roughly a 20% collapse. And then, it was 2 years later when the dot-com bubble blew and, the NASDAQ went down nearly 90% and S&P went down 50%. But just before that, we had this weirdness, right? We had the S&P 500 all-time highs with less than 50% of the members above their 50-day moving average. Haven't had it since until right now, okay? So does that mean that we have an epic decline coming? Of course not. Does it mean that the risk of an epic decline is there? Of course it does, along with valuations and the other things we've been talking about for the last nearly couple of years now. And of course we did get that 35% drop in 3 weeks. So folks, let me just repeat what I've been saying now for weeks, and clients, you've been hearing this in every review meeting. Our purpose, our professional purpose right now at PWA is not to beat the stock market. Under these circumstances, it is just not an issue for us, right? In fact, it isn't, and it shouldn't be under any circumstances. Could we? Absolutely. Why? Because barely 50%, just over 50% of our portfolio is even in the stock market. And when you say the stock market, you're thinking the S&P 500. Well, more than half of our exposure now isn't even in U.S. stocks. And then we have that, roughly a fourth in commodities. And we've added some positions this week, one in the communication space with Viacom, and I wrote about that, and I gave you kind of a summary of the thesis, a little more in rare earth miner, added a carbon credits ETF, right, that could be big going forward, and then Latin America, which is cheap, has underperformed, and is strategically positioned to do well in the years to come. So our objective is, though, to exploit opportunities like those, but to hedge portfolios through diversification and applying options where they make sense. Keep our wits about us, be very, very cognizant of the downside risk, and do smart things going forward. And I'll say it once again, compound at a decent rate, mitigate the big losses, and focus on what we should be focused on right now, and that is the risk that's inherent in the current setup. Folks, thank you as always for watching, listening. Hope you have a wonderful weekend. Take care.